Choosing the right foundation to protect your wealth or family assets is not always simple. If you're looking at Dubai's DIFC Foundation versus an offshore foundation in British Virgin Islands or Cayman Islands, you're not alone. Each option comes with its very own different sets of rules, banking option, and real-world impact. So in this video, I'll break down what makes these two types of foundations different, which key issues you need to consider, and how to decide which one fits your needs the best. Before we start, my name is Shiraz Wahid and I'm the co-founder at LepidusWealth, where we have helped many of our clients and families with trust, foundation, and other asset protection strategies in Dubai. If you would like my help in doing the same, you can apply for a free and customized asset protection plan by clicking the link in the description below. Now, to start off, let's clarify what each structure actually is. A DIFC Foundation is a legal entity established under the DIFC or Dubai International Financial Center with its own set of rules. The foundation is recognized as a distinct legal person, able to hold assets, enter into contracts, and protect wealth from both personal claims and business risks. It's entirely separate from the individuals who set it up. In contrast, an offshore foundation from British Virgin Islands or Cayman Island is also an independent legal entity, but it is established under the specific laws of those well-known offshore jurisdictions. Both types serve a similar core purpose. They let you separate assets from personal ownership, create legal continuity, and implement long-term succession plans. But the way that they do this and the global perception of each is very different. Now let's look at how these foundations work in practice. With the DIFC Foundation, you're operating inside one of the world's most heavily regulated and respected financial centers. Dubai and the DIFC has made a name for itself in this sector, with the English legal system based on common law principles. You get a public registry for transparency, but with the option to keep certain information private. Importantly, the structure is designed to be recognized by international banks and financial institutions, which can be critical when you need to open accounts or move assets across borders. Offshore foundations in places like BVI and Cayman operates differently. These jurisdictions are famous for privacy and tax neutrality. The registration process is generally fast, flexible, and offers very high level of confidentiality, sometimes to the point where very little is on public record. Offshore foundations are often used for holding international assets, estate planning, and sometimes shielding assets from the foreign country courts. However, in recent years, the global environment has changed. Banks, regulators, and tax authorities are now far more cautious with classic offshore jurisdictions. Many well-known banks either refuse to open accounts for BVI or Cayman foundations or impose heavy compliance checks that can slow down transactions and create delays. When it comes to benefits, there is no question that DIFC Foundation have become a preferred option for those who want legitimacy and long-term acceptance. With a DIFC Foundation, you get a structure that is fully compliant with international regulations and anti-money laundering rules, as well as automatic exchange of information. This means you can approach global banks and counterparties with confidence. Your foundation can hold shares in companies, real estate, investments, intellectual property, and even act as a partner in joint ventures. Dubai's reputation means your structure is more likely to be accepted by banks in Switzerland, the UK, Singapore, and major hubs. An offshore foundation in the BVI or Cayman still offers genuine privacy, flexibility, and the benefits of tax neutrality. For some international clients, particularly those with history of using these jurisdictions, it can be a useful part of an offshore layering strategy. The setup process is generally fast and cost-effective, but the biggest drawback today is perception and the practical difficulties that come from global de-risking. Many financial institutions see BVI and Cayman structures as red flags, which can make it harder to access banking, payment platforms, or even complete simple transactions. If your assets are all outside the banking system, this may not matter, but for most families and entrepreneurs, it's a growing challenge. Let's talk about asset protection, which is often the main reason for considering a foundation in the first place. Both DIFC and offshore foundations are powerful tools for separating personal risk from your core assets. With a foundation, assets are no longer in your name, so personal lawsuits or business failures cannot touch them, at least in theory. However, real life cases can be different. Courts in Europe, North America, and Asia are much more likely to recognize a Dubai based foundation as a legitimate, law abiding structure, especially if it is managed correctly and not used purely to hide assets. DVI and Cayman foundations, on the other hand, have come under increasing scrutiny from tax authorities and courts. In aggressive litigation or divorce cases, an offshore foundation may be easier to challenge, particularly if the setup was not done with proper legal advice and ongoing compliance. Succession is another critical area. Both DIFC and offshore foundations allow for detailed, customizable rules about how your assets will pass to the next generation. With a DIFC foundation, you can appoint a council, protectors, and clearly set out how assets should be managed and distributed over time. Because Dubai is a neutral jurisdiction, it provides more stability in case of disputes among beneficiaries or cross border family situations. Often, foundations also allow for detailed succession planning. But again, their effectiveness depends heavily on how the structure is viewed by the courts in the place where your family actually lives or holds assets. Now, you may be wondering about how the process and cost of setting up a foundation is. Establishing a DIFC foundation is relatively straightforward, but it does require you to work with an approved registered agent in Dubai, such as we at LepidusWealth. Costs are moderate, typically starting from a few thousand US dollars for the full process, including drafting the charter, appointing council members, and meeting all the regulatory obligations. There are also ongoing compliance costs, including annual filings and possible audit requirements, especially if your foundation holds substantial assets or operates a business. For BVI and Cayman foundations, setup is often quicker and can sometimes be slightly cheaper, depending on your service provider. Ongoing costs are lower and regulatory requirements tend to be lighter, at least on paper. However, what you save in compliance, you may end up paying for restricted access to global banking or increased scrutiny. One area where DIFC foundations really stand out is global acceptance. Dubai is not seen as a tax haven or secrecy jurisdiction, but as a major financial center with a clear, rule-based environment. This has significant advantages when you need to move assets between countries, invest in regulated markets, or respond to due diligence checks. Offshore foundations are more likely to face delays, refusals, or even account closures, particularly if you or your beneficiaries are tax resident in Europe, North America, or other major economies. It is a subtle point, but one that can make all the difference when you need to act quickly or preserve flexibility. It is important to note that neither of the structure is automatically a tax optimization tool. A foundation is not a magic bullet to reduce your taxes overnight. With DIFC, the goal is compliance and legitimacy, which means you are expected to declare your assets and income in your home country and follow all the reporting rules. The same is true for BVI and Cayman foundations. Although the historic association with tax planning means some advisory still suggests them as ways to minimize tax. Although the historic association with tax planning means some advisors still suggest these structures to minimize taxes. But in today's world, using a foundation to hide income or evade reporting is both risky and increasingly ineffective. For clients with truly global needs, such as holding real estate in multiple countries, managing international investments, or planning for cross border succession, a DIFC foundation provides a level of predictability and acceptance that is hard to match. It can be combined with offshore companies, trust, or SPVs as part of a multi jurisdictional strategy, but it sits at the center as the anchor. Offshore foundation, by comparison, still play a role for clients with niche needs or as part of a legacy setup, but they require careful management to avoid compliance headaches. Of course, no structure is perfect. DIFC foundations, while globally respected, require more documentation, ongoing reporting, and sometimes face questions from older banks that are not yet familiar with Dubai's legal system. Offshore foundations offer more flexibility, and in some situations, they may provide privacy benefits that are hard to replicate elsewhere. The best choice depends on your goals, your risk tolerance, and where you actually need to operate. If you are weighing your options, take a step back and ask yourself, what do I need most? Global acceptance and access to banking, or maximum privacy and speed? Are you planning to keep your assets in a highly regulated markets, or do you only need the foundation for specific ring-fenced purposes? The answers to these questions will point you towards the right solution. To sum this up, the choice between a DIFC foundation and an offshore foundation is no longer just about cost and privacy. It's about long term viability, access to financial markets, and ensuring your wealth plan works not just for today, but in 10 or 20 years for you and your family members. As I mentioned earlier, if you own a business or real estate, don't wait for legal or health crisis to start thinking about protecting your wealth. Many people think asset protection is only for ultra wealthy. But the reality is that some of these solutions cost as much as setting up a free zone company in Dubai. If you want to secure what you have built and ensure your legacy, you can request your free and customized asset protection plan by clicking the link in the description below. And if you're serious about building long-term financial security, you should really check out my next video right here.